Good day, everyone, and welcome to the Steel and Tube Fiscal Year 2018 Results Call. Today's call is being recorded. Please note we will take questions by phone only at the end of the call. At this time, I would like to turn the conference over to Steel and Tube CEO, Mark Malpass. Please go ahead, sir.
Okay, good morning. I'm also joined here by Greg Smith, our Steel and Tube's CFO. I'll start by covering financial summary on page 2. Firstly, our 2018 normalised earnings before interest and taxes of $16.5 million is slightly better than the guidance that we provided back in 23 May. You'll also note there are no changes from our unaudited results announced on the 7th of August this year. The 2018 financial year has been about resetting the company. We have addressed legacy issues and we've refreshed our board and management teams, and we have clear strategic plans in place. Revenues were slightly down, about 3% down on prior year, as we were impacted by the ERP implementation of our information technology system earlier in the year that impacted on customer service within the business. The result was also significantly impacted by the $53.8 million non-trading impacts from the legacy issues, which is consistent with the number that we advised on 23rd of May this year. There will be no dividend for the full year 2018 year. We plan to resume dividends in 2019. Our change program is well underway and benefits are being recognised, as I'll talk through a little bit later on. Moving to chart 3, in terms of key highlights for the 2018 financial year, operating key events included, as I mentioned, the refresh of our board and management team. We deployed the new ERP system, our information technology system, and as noted, we had implementation issues which are now resolved. We undertook a company-wide review at the end of 2017, which resulted in the change program that we announced earlier, which has aligned a number of our businesses under the distribution and infrastructure divisions. We commenced Project Strive, which is our business transformation initiatives, and we also opened 2 new facilities in Christchurch, one for processing and one for distribution. And we announced the exit of our Steel and Tube Plastics business. In terms of financial events for the year, we provided revised guidance on the 23rd of May, resetting our business and dealing with the legacy issues noted on the 23rd of May. Those results, as I mentioned, are slightly ahead of that guidance. Revenues were $495.8 million, earnings before interest and tax is $36.2 million negative, normalised EBIT of $16.5 million. That resulted in a net loss, including the non-trading items, of $32.1 million. Post-financial year end, we've also initiated a capital raising of an expected $80.9 million that will be used to strengthen the balance sheet and provide financial flexibility to execute our business transformation initiatives and achieve our longer-term strategic objectives. Lastly but not least, we are seeing the early benefits from Project Strive, our business transformation initiatives. We're seeing a positive trajectory that we saw in the last quarter of FY18 continue into this financial year. Moving to chart 4 to provide an overview on the business there. As noted on the left-hand side of the chart, our position in the value chain is really in the secondary processing and distribution segments. From a secondary processing perspective, we're bringing through both imported and locally produced products. We are also importing some secondary processed products, and then of course distributing those products through our supply chain, and in some cases such as reinforcing, we're involved in placing. On the right hand side of the chart you can see our overall footprint. That footprint is down from about 50 sites at the end of last financial year to 40 today, as we've integrated many of our acquisitions into our base business. Moving to chart 5, just to provide an overview of our businesses. On the left-hand side of the chart is our distribution businesses. These businesses are effectively trading businesses, so breaking bulk and distributing carbon steel, fasteners and stainless through our supply chain. We also buy from mills, meet their minimum order quantities, and move those products through our system as efficiently as we can. That accounts for about 58% of our revenues. On the right-hand side is our infrastructure businesses, which account for about 42% of our revenues. These businesses are more involved in secondary processing, made-to-order, and light manufacturing activities. Businesses in this segment include roll-forming businesses, so roofing, coil processing, purlins, and ComFloor, and also, secondly, our reinforcing and composite floor decking businesses that are also involved in installation and placing. Moving to chart 6, I wanted to provide you with an overview of our strategic initiatives. Our goal is to be the leader in buying, selling, and processing and placing products within New Zealand, and we've established 4 pillars to help ensure that we achieve this goal. The first is obviously a very strong commitment to safety and quality, which I'll cover shortly. Secondly, improvements in our operation and supply chain excellence program. Third, putting the customer at the heart of our business. And lastly, supporting that with a winning team. I'll touch on each of these 4 pillars as I go through the presentation. So chart 7 provides you with an overview of our health and safety and quality and employment engagement performance. You can see the chart on the left-hand side there showing a graph of our LTI, so lost time injury frequency rate, in the grey bar, which is reduced by almost 80% on prior year's performance, which is a strong positive. And then our MTIR, medical treatment injury frequency rate, which is also almost halved over the last 12 months. This strong performance has really been supported from the top of the organisation with our quarterly board Quality, Safety and Environmental Committee. It's also been strengthened by the Quality and Safety function, which reports to myself as CEO. We also have monthly stewardship covering lead and lag indicators across our business. High potential risk incidents are reviewed, and any non-conformance with quality performance are also reviewed in that forum. We've had a number of programs underway within our health, safety and environment area, and including the WorkSafe-based program, which is really about employees speaking up and having the power to speak up on a regular basis. We've also had a very robust back-to-work program that we followed the Christmas break to remind employees that they're back in the workplace in a potentially dangerous environment. We've also been focusing on employee engagement, and that has included regular internal communications to ensure clarity of purpose. And in a couple of months, we'll have launched our first Excellence Awards, which will be recognising and celebrating contributions and achievements across our business. We also completed our engagement survey in June, which was an overall engagement survey result of 70%. Moving to chart 8, our change program. I won't go into detail on this timeline as I covered on the earlier chart in terms of the key events that have occurred over the financial year. So we'll move on to chart 9, which is really covering Project Strive. Now, this Strive is supporting the 4 pillars that are outlined earlier. Project Strive is encompassing about 25 projects across the business that are really driving improvements in performance. And we've been stewarding our Project Strive initiatives through a project management office, and they're really helping to transform many parts of our business. You can see the 4 pillars on the left-hand side of the chart, and we've included a number of the initiatives that we have underway. Not all of the 25 I mentioned, but certainly a large chunk of those initiatives are shown on the right-hand side of the chart. For example, in the area of safety and quality, we've been implementing an ISO 9000-2015 update. We've just signed up Lloyd's to complete all of our mill certification on an annual basis. We're also rolling out barcode scanning across our business to improve traceability. In the area of customer initiatives, many sales improvements and disciplines are occurring within the business there. We've launched some new products in terms of a new composite floor decking system, and we've also deployed some new vans in our chain and rigging business. We launched this week the BIM spec product launch, which you will have seen, those that were online earlier in the week. And we're also launching a loyalty program coming up within the next month. So a number of areas within the customer space that will lead to a point of difference, as well as obviously our improved service offering. Thirdly, our operations and supply chain excellence program has certainly well underway, and we're seeing improvements through more sophisticated pricing systems, improvement and tighter control over inventory. Our operational excellence program is resulting in improved machine efficiencies within our reinforcing and roofing businesses. We've moved to same-day service on our freight side of our business and improving recoveries there, and are well on track in terms of implementing our integrations. Prior acquisitions have been integrated into our business. Last but not least is supporting a winning team, and as I mentioned on the prior chart, there's a number of initiatives that we have underway to retain and attract talent going forward. Moving to chart 10, I'll cover briefly the non-trading impacts that were outlined in our 23 May announcement. These obviously had a material impact on our FY18 year earnings. In total, $54 million of impact, and I'll just briefly cover all of them. Inventory was the largest piece of about $24 million. 15 of that was inventory value adjustments, and the remainder was stock write-offs. We also had the plastics exit of about $10.9 million. We impaired a number of intangibles on our balance sheet, as well as partial ERP to the value of about $12.1 million. We had some rationalisation costs of about $2.7 million and organisation restructuring of $3.3 million, combined with other of $0.8 million, resulted in the $53.8 million impact. These are obviously big numbers in terms of impact to shareholder value, but we now have cleaned up our legacy issues and can move forward with a clean P&L and balance sheet. I'll hand over to Greg now for chart 11 to cover our interest before earnings and taxes.
Thank you, Mark. As Mark's already outlined, our reporting normalised EBIT of $16.5 million for the financial year ended 30 June 2018. That's down about $14.7 million on earnings from the prior year, and as previously signalled, the implementation of our ERP system didn't go well and had a significant financial impact on the business this year to the tune of around $9.3 million. We've also got some structural cost changes that we're working now to do a better job of recovering. Obviously, running a new system costs more than an old legacy system, as well as some additional lease costs from sale and leasebacks that the company has undertaken. Also included in that is the full year benefit of CFDL, an acquisition made in the previous year, so there was an extra contribution to the result from that. And underlying that, there has been some trading differences, predominantly in the traditional distribution and reinforcing businesses. But as Mark signalled with the transformation program, we're well underway to addressing those issues and turning those around. So no change from really the figures previously reported, both unaudited and also consistent with the earnings guidance released in May. One point also to note, when we released our earnings guidance in May of $16 million, subsequent to that, we did get a $1.1 million benefit from delaying the start date of amortising our new IT system, as we spent more on addressing the issues in the second half of the year. But we've acknowledged that by reporting $16.5 million on a like-for-like basis with that previous earnings guidance. Just now, turning to slide 12, our balance sheet. That really reflects the impact of the issues Mark's talked about. So the inventory write-downs, we've sold 2 properties during the year, the intangible asset write-downs we've undertaken as well. And I think, you can see that from the reduction in both inventory, property, plant and equipment and intangibles on that balance sheet. Excluding the property sales, net debt did increase on an underlying basis, and reflecting the impacts of, the lower revenues and the tail end of a high capital investment program, in FY18, and acknowledging that working capital is an area that this business is seeking to improve with a clear focus on that as we move forward. Clearly, the capital raise will significantly de-gear our balance sheet, providing us with the flexibility to transact the initiatives we're looking to do as we move forward. On slide 13, just a bit of background and history on our capital investment program. You can see there over the last 4-year period, the company spent around $80 million on acquisitions. That approximates the amount of the capital raise that we are now seeking to raise through our pro rata placement and rights offer. 2018 was the end of a high capital investment period for this business, both in terms of IT and in property. As we move forward, we expect to return to a lower level of base capex that sort of fits in line with our cash flow and enables us to both leverage the investment we've already made, particularly in technology, as we move forward. Moving on to slide 14, our capital structure policy, as we've previously advised, we're targeting net debt to net debt plus equity to be, less than 30 to 35%. And following the capital raise, our net debt to EBITDA target is less than 2 times that we are seeking to operate within, and we expect to operate within those post the capital raise. We did not meet the targets in FY18 for the reasons previously aligned, and as Mark noted, whilst there's no final dividend to be paid for FY18, we expect to resume dividend payments from the interim for FY19 onwards. There is no change to our dividend policy. It continues to be a target payout of between 60 and 80% of normalised earnings. That's the conclusion of the capital structure. I'll now hand back to Mark to take through the operating segment results.
Okay, thanks, Greg. Moving to chart 15, the operating segments. Our operating performance there is outlined on the left-hand side of the chart. Revenue was down 3% year on year. This was the result of the impact of the ERP implementation as well as volume and margin pressures. This was partially offset by the addition of CFDL, Composite Floor Decking Limited revenue, and a number of large projects that Steel and Tube Plastics had won in the first half of the year. EBIT was impacted by the implementation of the ERP and the non-trading items that we've mentioned earlier. Moving to chart 16, which is detailing our distribution division. This is our core trading business and also includes both heritage distribution as well as our stainless and fasteners businesses. The performance in that business was also impacted by the ERP issues, which are now resolved. The majority of our non-trading costs in the distribution division were the impairment of inventory following the extensive stock take process that we went through, as well as business rationalisation costs, in terms of facilities and people restructuring costs that came through the distribution division. We opened a new distribution facility at Blenheim Road in Christchurch. Project Strive has also identified a number of business transformation initiatives within distribution. The customer service improvements that we've made are driving sales, particularly as we've moved to same-day sales in our critical Auckland market. We've also deployed a sales and operations planning model across the distribution business, which is heavily integrating our supply chain activities. We have streamlined duplicated facilities, as I mentioned earlier, with the acquisition sites being combined into our heritage business operations. We've also improved our inventory management processes since the write-downs that we noted earlier in the paper. The benefits of the business transformation initiatives are having a positive impact on our year-to-date results. We're seeing a number of large project wins in late 2018 are also coming online, and we see further efficiency initiatives expected to deliver savings in 2019. Moving to the infrastructure division on chart 17, this includes our secondary processing, light manufacturing and placing businesses. So that includes roll forming, reinforcing and the composite floor decking business. Non-trading adjustments included the impairment of the plastics business and also inventory write-downs within the rest of the infrastructure division. Reinforcing has been repositioned as a leader in the quality products and service in its markets. Roll forming has also overcome the ERP implementation issues earlier in the year. The roll forming business now has a very solid order book of close to $3 million. The composite floor decks business has also retained its very strong performance, although we have seen some softening in the South Island. The composite floor decking business has an order book in the mid-teens of millions of dollars, so the business is performing very well. And we've opened a new coil processing hub in Christchurch at our Seymour Street facility. Project Strive has developed a number of initiatives that are underway within the infrastructure division, so we're building our base customers. We have also delivered further manufacturing and operation efficiencies. These positive wins have seen us pick up a number of projects as we've been able to lift manufacturing efficiencies and performance within the reinforcing business. Move now to chart 19, which is part of our operating outlook, and I'll start with a quick overview of our operating sectors. We're well balanced across the construction, manufacturing and rural segments. About 45% of our sales are linked to construction, so of that 45, about 80% of that is non-residential. Further to construction, we also have about 41% of our revenues exposed to the manufacturing segment, so quite similar to construction in terms of exposure for us. Manufacturing is far less cyclical than the construction segment, so if you looked over a 20-year period, manufacture's been growing at about 3% versus 5% for the construction businesses. Last but not least, our rural segment exposure, really through our stainless steel businesses, is mainly the dairy and viticulture markets that we're exposed to there. So, we have a nicely balanced portfolio across that construction, manufacturing and rural markets. Moving to chart 20 provides some up-to-date current industry information. And you can see a fairly solid forecast in terms of longer-term growth. We've seen strong growth over the last 12 months in dwellings and non-residential. The North Island has been a key driver of that in the main centres, driving demand. The forecast is for consistent building and construction activity in the next few years. Total construction is expected to top out at about $41 billion by 2023. Residential building is expected to hold fairly steady over that period with a forecast high of about $27 billion by 2023. Non-residential building value is forecast to peak in 2019 at about $8.5 billion, while infrastructure is forecast to remain relatively unchanged, increasing marginally to about $7 billion by 2023. And you can see on the right-hand side of the chart, 5-year annual building consent, regional information from Statistics New Zealand that was issued in June, and then on the lower right-hand side, all construction activity that was released recently by Brands and Pacificon, also in June. Moving to chart 21, in terms of the broader, more global operating environment, certainly we have seen over the last 12 months global steel production increasing by about 5% to 1.7 billion tonnes during 2018. China's output increased to about 5.7% over the year, and that was mainly consumed domestically within China. We have seen on the bottom right-hand side there, East Asian steel prices have continued their upward trend, although have flattened in the second half of the year in US dollar terms. But of course, with the softening New Zealand dollar, that is putting pressure on domestic prices, as we've seen a firming of prices, and many of our competitors and ourselves appear to be reviewing prices, and we're likely to see some more upward moves in prices over the next 1 to 2 months. Moving to chart 22 provides an overview of the positive impact of the initiatives that we're starting to see in the business. On the left-hand side of the chart is our distribution division, covering all businesses within that division, so heritage distribution as well as stainless and fasteners. And on the right-hand side is our infrastructure businesses, so roofing, core processing, peelings and Comfloor. The top half of these charts is showing daily tonnes or volume, and the bottom half is showing the sales performance on a daily basis. You can see the dotted line, prior year performance over the 5 months noted from March through to July, and the red line is showing our current performance, and that trend has continued as up to today. So we are starting to see some green shoots coming through in terms of our volume and sales performance. Moving to chart 23, which is providing some guidance on our 2019 outlook of $25 million. With the legacy issues now behind us, we can now focus on a journey of really increasing our operating and financial performance going forward. We've made the structural changes in our business through our Strive program, and they are now gaining momentum. And our operating cost reductions are expected to continue to realign with sales over the next 12 months. So that sees us moving from a normalised EBIT of $16.5 million to $25 million by the end of FY19, largely driven by Strive benefits. We do have some increased costs associated with salaries and wages, which is really an expectation that we'll return to bonuses, a little bit of CPI in there. Then we've seen the rent and leasing costs come through from the buildings that Greg mentioned earlier that we've sold, and then some general efficiencies coming through in terms of other expenditure to get to that $25 million. Lastly, just moving to chart 24, in terms of our medium-term objectives, we see normalised EBIT moving to between $35 and $40 million over the next 3 years as we capture the benefits from our Strive program moving forward. Okay, that is the end of our presentation. We'll now hand over for questions.
Thank you. If you'd like to ask a question over the phone, please do so by pressing star followed by the number 1 on your telephone keypad. If you're calling from a speakerphone, please make sure your mute function is off to ensure your signal can reach our equipment. Again, star 1 to ask a question. We'll go first to Matt Henry from Forsyth Barr. Your line is open.
Hi, morning guys. I just wanted, you talked about improved sales trajectory in the fourth quarter in July. I see that second half sales are down, I think it's 11% year on year. Are you able to give us some quarterly splits in what July is on a year on year basis?
Yeah, I mean, Matt, just firstly, the sales were down in the second half there due to the main impact of the ERP system implementation was felt in the third financial quarter of the year, and so that had a heavy impact on our sales during that period. I guess the period since March, which you can see in the charts there that I showed earlier, March, April, May, June, we've seen improving sales performance, but we certainly had a tough time in that third quarter of the financial year, which has heavily impacted on our EBIT performance.
Can you give us any sort of exact numbers on what your third quarter year on year was versus fourth quarter and maybe July, given I take those trend charts you've given, but can you give us any exact numbers, or is that not possible?
Oh, look, you're not prepared to share the quarterly data on the call. I mean, what I can confirm is certainly in July and August to date, we have continued to see a similar trend in improving sales performance.
Okay, so I take that as being up year on year?
That's correct, yeah.
Okay. And sorry, just looking back at the sort of jotting down from the earlier this month's presentation, could you just confirm that CapEx depreciations expectations around about kind of $9 million for next year onward? Is that right? I've got that correct?
Yeah, that's right, Matt. As Greg noted, we plan to get our CapEx back in line with depreciation.
Okay, that's all I had. Thank you.
Thank you.
And again, if you have a question, please press star followed by the number 1 on your telephone keypad. We'll go next to Stephen Hudson from Macquarie Securities. Your line is open.
Oh, hi guys. Just a couple of quick ones from me. The wage inflation that you've built in for 19, I just wondered if you can give us a feel for that. It looked quite strong over 18. I think it was up sort of 14%. So it would be useful to get an idea on that. IFRS 16, I just wondered if the benefit to EBIT has been included in your long-term guidance for EBIT. And thirdly, thirdly, there's a $1.5 million gain on the sale of property. I just wondered how you've treated that in terms of normalisation. And then lastly, just back to Matt's question, I think distribution sales were down 11% in the second half. Infrastructure was down 12 versus -1 for distribution in the first half and +15 in the first half for infrastructure. So I think it's pretty important that you share the fourth quarter numbers with us, given that you've sort of publicly stated that there's been an improvement.
Okay, Stephen, Greg Smith here. Just make sure I cover all your questions. So wage inflation is, in our expectations, is around 2 to 2.5%. It's just a normal sort of salary escalation. I think what you may be referring to in our financial results, we did have some additional labour costs in the year as we brought on additional workforce to improve our ability to service our customers, particularly in that sort of placing area around the reinforcing business, plus you've got a full-year impact of the CFDL acquisition. In terms of our future outlook, it's a good question. We haven't specifically allowed for IFRS 16 benefits at this time. We still to work through the full impact of that on our business. In terms of the gain on sale, that has been excluded from normalised earnings, so we've not included that in the number to be clear. And in terms of splitting between Q3 and Q4, I don't have the detail to hand, but we'll have a look at that and see what we can provide on that basis.
Okay, thank you.
Unless there's any further questions there coming through, I just see on the screen there, was there a question? No, okay, no questions there. All right, look, unless there's any further questions, we'll close off the call. Okay, all right, thank you.
And this concludes today's call. Thank you for your participation. You may now disconnect.